Making his biggest bet yet on the future of the American economy, but still our next guest remains pessimistic. Thanks to Ben Bernanke, of course. With the Fed meeting underway in Washington, he has some choice words for the nation's top money man. With us now, Fast Money friend Peter Schiff, president of Euro-Pacific Capital and author of Crash Proof. Peter, always good to see you. Want to start off with the big news of the day in the markets, and that is Warren Buffett's big bet on America. A lot of people have seen you on our program many times. They might come away thinking that you're sort of bearish on America. What do you know that Warren Buffett is not recognizing?
Well, first of all, I think India just made a bigger bet against America by buying 200 metric tons of IMF gold. And I don't necessarily think that Warren Buffett is betting on America buying into a rail. Well, that's what he said, but look at what he's doing. He's buying into a commodity play. I think he's buying a railroad because if oil prices keep going up, as I believe they do, that makes trucking less competitive. And I think a lot of the freight that they're hauling on those trains, there's a lot of raw materials, a lot of things like coal that are going to be exported to China. I think he wants to get out of cash. I think he's looking for inflation hedges. I don't think it's that big a bullish bet on America.
So you're not a Dow theorist, I take it then?
Oh, because the transports were up?
Exactly.
No,
well, I mean, if he's betting on a transportation name, there is an inherent belief that this transport name will go up. When
well,
the
let's
Dow
look at what they're transporting.
That's positive. Okay.
Yeah, look at what they're, and ultimately, he may be betting on the new American economy, which is going to be focused on exports and real production. But before we can get to that new America, this phony American economy is going to have to collapse. And I think the Indians know that, and that's why they bought all that gold.
Okay.
Peter, I got a quick question. I know you wrote a letter to Ben Bernanke, an open letter. If you look right now in terms of consumer spending, clearly it's not there. This is a balance sheet recession that we're worried about right now. And in that recession, the public spending, the government spending, has replaced the consumer spending. Do you believe that that was correct for the government, the public spending, to come forth? And if they didn't do it, who then would replace the consumer in terms of spending?
Well, absolutely not. We don't want the government to replace that spending. The fact of the matter is we've been spending too much. We need to spend less. We need to save more. When the government steps in and tries to fill that void, they're preventing the free market from rebalancing our economy.
So if the government does not then step in and replace the consumer, doesn't then Armageddon come before us all because no one's spending?
No, we're going to have a severe recession. There's no way around that because, you know, we blew up this big bubble. But no, what's going to happen is if we save money, then businesses will be able to take those savings and invest it so that we can become more productive. We'll be producing more and exporting to foreign consumers. But the only way to restructure our economy, Americans have to buy less because we're broke. We went for a generation consuming too much, and now we're in debt.
But we
have
are
to stop
less, Peter,
that.
and in fact, consumers are saving more, and lower interest rates are helping them to get out from under that. You start raising rates, you're going to strangle people. Corporations have plenty of money. They could be spending it. They're not spending it either. I mean, what do you do tomorrow if you're the Fed in your statement to change all that?
In order to get higher savings, we need to have higher interest rates so that people are paid to save. But right now, if you put your money in the bank,
people have a net deficit. That's going to crush them. They're not net savers at this point.
But we need to change that, and we're not going to bring that change around if we keep interest rates artificially low. No, if we keep interest rates artificially low, we're going to destroy the currency. We're going to be talking about, you know, gold not just going up, you know, $25 in a day, but $50, $100 in a day, $1,000 in a day. We're going to see huge moves if we don't stop this soon.
So, Peter, it's Karen. Where should interest rates be if you were Ben Bernanke? Where would you have them right now?
Well, the market would be setting them, but I think they need to be a lot higher. I mean, we have no domestic savings, really. We're borrowing all this money. In order to clear the market, we need much higher interest rates. Now, I know that's going to bankrupt a lot of companies in the short run. There's no way around that. We can't try to keep companies artificially propped up by suppressing interest rates because we're going to destroy the dollar, and that's worse. I'd rather save the dollar and save the economy than try to keep this phony thing going.
All right, so Peter, let me just buttonhole this whole thing. You would potentially invest alongside Warren Buffett in a railroad because that is a good hedge and it's really a commodity play?
Well, I don't think that's the best hedge. I think there are better places that Warren Buffett could be investing, but I'd certainly rather own a railroad than U.S. Treasuries or dollars, and that's what he used to own until he bought it. So he did get rid of a lot of cash that's going to lose a lot of value.
Peter Schiff, always good to talk with you.